So, like everybody else in the professions, wealth managers, CPAs, attorneys, was doing all this reading late last year about the fiscal cliff, and I said, I want to know what the fiscal cliff looks like. So I went out to find it. What I want to do is I want to talk about how I think these changes will affect different kinds of taxpayers, like business owners, real estate owners, and so forth. And I also want to talk about how it will affect those of us who serve taxpayers and families who own successful businesses, who own real estate, and so forth. Did any wealth advisors in the room have clients go totally haywire at the end of the year and dramatically change their asset allocation because they were worried about the fiscal cliff? Anybody? I'm just curious. I didn't think so. I know the people I work with, the family offices that I work, very high net worth families, nobody really worried about changing their asset allocation even nominally, let alone dramatically. We did see, however, significant capital gains, long-term capital gains being taken in the fourth quarter of 2012. And one interesting change that I'm starting to see, and I've been seeing this actually in anticipation of the fiscal cliff starting about 2 years ago, many high net worth families have certainly begun to move away from traditional asset allocation. By traditional, I mean stocks and bonds and mutual funds, more towards what we call non-traditional assets. In other words, investing in things like distressed debt funds, hedge funds, real estate funds, as the case may be. Clearly, things like income tax returns and living trust, at least by the paying public, are perceived to be commodities. All right? And the problem with that is it means that usually the first question you get when somebody asks if you can prepare a tax return is, how much do you charge to do a 1040? Or how much do you charge to do a living trust? Okay, there are now, in my opinion, more estate planners in this country than there are clients who need estate planning. Some of you know I spent a lot of time talking to CPA firms. I have never in my 4 years in business seen staff morale at CPA firms as low as it is now, because I think they're being asked to do too much and there's not enough time or resources to do it with. And this compressed tax season is certainly not helping. So for practitioners who are interested in setting themselves apart from the crowd, I think, in my humble opinion, the American Taxpayer Relief Act of 2012 is a total and complete game changer that will allow certain people who are opportunistic enough to take advantage of the opportunity to differentiate or brand themselves, set themselves apart from your competition. And if succession planning is one of your issues, if you're trying to transition your practice because you're, say, 55 or 60 or 65 years of age, if you're trying to successfully transition that, again, I think it's a huge opportunity. Obviously, for businesses that are doing well, that are successful, huge opportunities to bring more valuation into the equation. In many cases, families say, yeah, my business is worth $10 million because my cash flow is $3 million, but they've never had a business valuation done. I think professional service advisors have to be much more sensitive to the importance of helping high net worth families really ascertain the correct and true value of the key assets in their family, as opposed to writing things down on the back of a napkin because your next door neighbor got 5 times gross or 5 times EBITDA. There's a huge opportunity for practitioners to get involved in helping business clients raise capital. That includes valuation, that includes strategic planning, entity selection, all kinds of things. But not too many people seem to be up to speed yet on the Jobs Act. I would strongly recommend you spend some time reading about that, because I think in the context of increased tax rates for practitioners who are looking to bring better value to business owners, Jobs Act is a significant opportunity to help. I just wanted to touch on what I think it means for people who are serving these kinds of families. I've identified the 5 kinds of people who tend to be A clients of CPAs and attorneys and wealth advisors. And I think I've thrown out some ideas about maybe ways we can approach these clients to bring better value to them. Professional service advisors have a huge opportunity because of what a game changer after 2012 is, but we have to do 2 things, okay? We have to be good at collaborating, and I know we had an announcement about groups getting together to promote collaboration among other groups. I think that's serious business. I think the days of the competitive business environment has been replaced by collaboration. And the second thing, advisors have to be really good at becoming managers of relationships with their best clients and relationships with the people that they collaborate to serve those clients. I think that's the future of the professions, particularly as it relates to these kinds of families that I'm describing. Significant real estate owners, owners of closely held businesses, and high net worth families. For me, the answer is collaboration and relationship management.